Hello, welcome to the today's class. In today's class, we will be discussing actually the inventory issues, inventory measurement. Okay, and today's class has two parts. In the part one, we will discuss the inventory issues. For example, the cost of goods sold and physical units included in inventory, meaning which units should be included in the inventory count. And we will solve two problems. The first one, calculating the correct inventory amount, and in the second one, we will uh, solve a problem that is mostly related to the various journal entries. So, what is inventory? The first one is, as we know, that inventory is the amount of units, meaning the unsold units. Okay, say for example, you have produced 100 units and you have sold 80. So 20 units is your inventory. The other thing is also true in case of merchandiser. You have purchased 100 units and you have sold 80 units. So your inventory is 20 units. And what is cost of goods sold? Cost of goods sold is actually related to the inventory that we have sold. Okay, cost of goods sold, the amount of goods that we have sold. Okay, and there are two different types of inventories. The first one is the merchandising, and the second one is manufacturing inventory. Merchandising means the merchandisers usually buy and sell. Okay, if say merchandisers buy 10 units and sell say 7 units, so the 3 units is the merchandisers inventory. Okay, and for the manufacturing company, the inventory actually, there are three different types of inventories: the raw materials, the work in process, and finished goods. But in our financial accounting, we will be most likely talking about the merchandising inventory, not about manufacturing. But let's see what are the manufacturing inventories. Okay, so there are raw materials. So it is the materials, it is the component of a finished goods that we usually use to produce something. And work in process, in the work in process, we usually add the raw materials, then add the labor cost and manufacturing overhead, and finally the finished goods, the completed manufacturing products. So there are, these are the three different types of inventories in manufacturing company. And in the manufacturing company's balance sheet, the three types of inventories are shown as the raw materials, work in process, and the finished goods. This is how they uh, report the inventories in their financial statements. And let's see the cost flow for a manufacturing company. As we can see that the raw materials, then direct labor and manufacturing overheads, they go to the work in process, and finally work in process is converted into finished goods. Okay, as we know that there are two different types of inventory systems. The first one is perpetual inventory system, and the second one is the periodic inventory systems. And in the perpetual inventory systems, when we purchase inventory, we usually record the inventory debit and accounts payable credit in case of purchase on credit. Okay, and for the sales, we usually debit accounts receivable for the credit sales. But in case of cash sales, we will be debiting cash. Okay, so and sales revenues, revenue is credit. And for the cost of goods sold, we will be recording the cost of goods sold debit and inventory. So for sales, there are two journal entry in case of perpetual inventory systems. Okay, and let's talk about the periodic inventory system. In the periodic inventory systems, we usually count the amount of inventory after a certain period of time. So that is why we call them periodic inventory systems. We usually count inventory, say after 30 days or after 60 days or after every 90 days. So that is why we call it the periodic inventory systems. And to calculate the cost of goods sold under the periodic inventory systems, we use this formula. So beginning inventory, let's have an example. So we have, say, beginning inventory of $100. Okay, these are all dollars. Okay, and we have purchased inventory for, say, $20, and we have any inventory of $10. So our cost of goods sold would be equal to, say, $110. Okay, so let's see how we record the purchase and sales under periodic inventory systems. So this is how we record the purchase. See, under the perpetual inventory systems, we have recorded inventory first, meaning we have debited inventory, but in this case we are debiting purchase and accounts payable credit. And for the sales, we will be recording only one journal entry, that is only for sales. So in case of credit sales, we will be debiting accounts receivable and credit sales revenue, and no entry is needed for the cost of goods sold. So how to record the cost of goods sold under the periodic inventory systems? As we know from the formula, the beginning inventory plus purchase less any inventory. So it is easy, it should be easy. See, we have the beginning inventory this amount, then we have purchased this amount, and this is the sales, and this is the amount of any inventory in our hand. And so beginning, then purchase, and finally less any inventory, and we got the cost of goods sold. And how to record the cost of goods sold? See, cost of goods sold debit, then any inventory debit, beginning inventory credit, and purchase credit. Okay, can you solve this one? What is the cost of goods sold? Please pause the video and try to solve this one. It should be easy, right? I hope you have solved this one. Here is the answer and how we did it. See, beginning inventory plus purchase minus purchase returns and minus any inventory, and this is our cost of goods sold. Here is another problem. Please pause the video again and try to solve this one. Here is the answer and how we did it. The second part, physical units included in inventory. So what are the units that we need to include in physical counting of the inventory? So the first thing, the amount that we have in our possession, number one, and goods that are in transit. But there are some factors we should consider, whether the goods that are in transit means the goods are between buyer and seller. Here are the goods. Okay, so buyer and seller, who is the owner of these goods? Okay, we should be careful about that. Okay, and then number three, goods on consignment, and number four, we need to predict, we need to estimate the anticipated sales returns. Okay, these four factors we will be considering in case of physical units that should be included in inventory counting. Okay, so the first thing, the goods in transit. So the goods that are in transit, the ownership of the goods depends on the terms. whether the free on board is shipping point or destination. Okay, for the shipping point and for the destination, let's see uh, one example with the help of an image, a diagram. Okay, so very quickly, here is the buyer. Okay, and here is the seller. Okay, I'm writing this one is the buyer and he is seller. Okay, and there is a C over there. See, and here is the sheep. Okay, and these are the goods and the sheep. I'm just drawing a sheep. Okay, so who is the owner of these goods? Okay, it depends on some terms. So I'm writing the first one is free on board shipping point. Okay, I'm not writing the point. So shipping point. This is shipping point. So in case of shipping point, okay, the ownership of the goods in transit goes to the buyer. Why? Because the condition is, say here, this is the dock, dockyard. This is the dock of the seller. So as soon as the ship leaves the seller's dock, okay, the ownership goes to the buyer. Okay, so that is why the goods, meaning the ownership of the goods in transit, goes to the buyer in case of free on board shipping point. And buyer also is responsible to pay the freight cost. Okay, and in case of free on board, in case of free on board destination, okay, free on board destination. Okay, so the seller's responsibility is to deliver the goods to the buyer's dock. So up to this point, okay, up to this point, until this point, the ownership goes to the seller. So for free on board destination, the ownership of the goods in transit goes to the seller. Okay, let's see, let's solve one problem. So this is one problem. So please pause the video and try to solve the problem. Okay, I hope all of you have tried this one and be able to do this one. Okay, so let's see the problem first. So the Barrington Corporation uses the periodic inventory system. Okay, at the December 31st, 2018. Okay, the end of the company's fiscal year, a physical count of inventory revealed and any inventory balance of 80,000. Okay, the following items were not included. So the question should be whether we should include them in the counting or not. Okay, so these three. The number one, the merchandise shipped to a customer on 12/28. The term was free on board destination. Okay, and the merchandise arrived at the customer's location on the 1st January 19. The second one, uh, in this case, Barrington is also the seller. They shipped the uh, merchandise on 12/29 and the shipping point, and the customer received it on the 2nd January. And the third one, merchandise purchased from a supplier. In this case, the Barrington is the buyer and the term is free on board destination, and Barrington has received the goods on January 4. Okay, so here is the answer and let's see the explanation. Okay, the first one, merchandise shipped to customers and the term is free on board destination. Here The Barrington is the seller. Okay, and let's see the. Okay, here is it. Here it is. See, the free on in case of free on board destination. Okay, the goods that are in transit. Okay, the ownership goes to the seller. Okay, and at this point the ownership will be transferred, but the goods still are in transit. So who is the owner of these goods? Barrington, right? So we will add this. So the goods are in transit and the decision is Barrington should include the goods in their inventory counting. Okay, so Barrington should include the inventory costing 3,000. Okay, the second one. So merchandise shipped to a customer. In this case, the term is shipping point. Okay, and here Barrington Corporation is the seller again, and let's see, it is free on board shipping point, and the uh, ownership actually is transferred at this point. Okay, so these goods, meaning the ownership of these goods, transferred to buyer. Okay, these are the goods. They are in transit. So goods in transit, the ownership goes to the buyer. So that final decision is Barrington should not add this 1500 with its inventory. And the third one, merchandise purchased from a supplier. Okay, and the term is free on board shipping point, sorry, destination. And in this case, Barrington is the buyer. And what is the condition here? See, since that term is destination and Barrington is the buyer. Okay, so actually ownership transfers at this point. So these goods in transit. Okay, so the ownership should go to the seller, and Barrington is not the seller. Barrington is the buyer. So the ownership goes to the seller, and these goods in transit will be included in seller's inventory, not in buyers, meaning not in Barrington. So the final decision is Barrington should not include 6,000 with its inventory. So this is the final answer, as we know. Okay, so answer is 83,000. And how about the goods on consignment? So in case of goods on consignments, let's have an example. Say here is Alex, okay, and here is Bob. Okay, Alex is in Texas and Bob is in Albuquerque. Okay, Alex produces some goods that he wants to sell in Albuquerque, and Bob has a store in Albuquerque. Okay, so Alex wants to keep some goods in Albuquerque, meaning in Bob's store. Okay, so the ownership of these goods is not transferred to Bob. Okay, so the ownership of the goods that are kept in consignment with Bob's store actually goes to the Alex. So when Bob will be counting his inventory, he will not include these goods that are kept on consignment from Alex. So in this case, Alex is the consignor and Bob is the consignee. So the goods that are kept in consignment, so the ownership goes to the consignor, not to the consignee. Okay, be careful about that. Okay, and the sales returns, we need to careful about the sales returns. We need to anticipate how much units may be returned to us. So we will be including the amount of anticipated sales returns with our inventory, so that we can have exact amount of sales inventory in our inventory count. Okay, so The discussion is up to this, and let's solve two problems. Thank you so much.